So imagine running a business where, the market price of your core product just surges by like more than $1,000 almost overnight.
Right, which is just unheard of.
Exactly. You wake up and the exact same widget you were selling yesterday is suddenly commanding this massive 35% premium. I mean, in almost any other industry, that scenario makes you invincible, right?
Oh, absolutely. Your margins explode.
Yeah, your competitors look on in envy, and your biggest problem is literally just figuring out where to park all the cash. But what if the very act of producing that widget, like the fuel you burn, the local currency you use, the taxes, starts siphoning away that windfall just as fast?
Yeah, it becomes this treadmill where you're running faster than ever, but it's cranked up to a near sprint.
Exactly. And welcome to this Talk Tickers Deep Dive. I'm so glad to get into this with you today.
Thanks. I mean, it is the ultimate paradox of a commodity supercycle, right?
Right. Oh, totally. Our mission today is to break down the Q2 2026 earnings call for AngloGold Ashanti, specifically for you, the retail investor. Their ticker is AU, by the way.
Right. And it looks like pure euphoria from the outside. But inside the control room, it's a desperate, really complex battle against structural inflation.
Yeah, the very macroeconomic forces pushing your selling price to record highs are the exact same forces dragging your operating costs into the stratosphere. And that is exactly what we are going to tear apart today.
Because looking at a major gold miner in a $4,400 gold environment is, well, it's thrilling, but it's also terrifying.
It really is. So we're going to cut through the Wall Street noise, present the hard data, and give a clear, opinionated take on what these results actually mean for your portfolio. Are they a coiled spring for investors, or just a mirage built on inflated commodity prices? Okay, let's unpack this.
Yeah, because if it's just the gold price doing the heavy lifting, then, any generic gold ETF will do the job.
Right, exactly.
To justify holding individual equity in a miner, you really have to prove that the company itself is capturing that margin, not just riding a wave that could crash.
Let's get right into the reality of that margin, starting with the headline numbers. And we'll do a rapid-fire breakdown of the most critical top-line and bottom-line data points.
Sounds good. Hit me with the top line.
So the basic earnings per share, the EPS, for the second quarter came in at $1.97.
Wow.
Yeah. And if you look back exactly 12 months to the second quarter of 2025, they were sitting at $1.32. That is a massive 49% year-over-year jump.
It's a staggering leap. I mean, to put that in perspective for you, a 49% EPS growth rate is something you typically expect from like an aggressive early stage tech firm.
Right, like scaling software with zero marginal cost.
Exactly. To achieve that in the mining sector, where every incremental unit of profit requires moving tons of physical rock, using heavy explosives, and managing tens of thousands of workers,
is just structurally profound.
It really is. It means the core engine of the business is firing with incredible efficiency.
And that efficiency shows up in the EBITDA as well. Earnings before interest, taxes, depreciation, and amortization. They hit $1.97 billion for the quarter.
That's a funny numerical coincidence, right? Matches the EPS perfectly.
Yeah, $1.97 versus $1.97 billion, but that represents a 46% year-over-year jump.
Which tells us that the operating profitability of the mines themselves, before we even start talking about accounting adjustments, is just fiercely robust.
But accounting profits and EBITDA can be massaged. They can be distorted by non-cash adjustments.
Oh, absolutely. They do it all the time.
Right. So for anyone looking at their portfolio, the metric that actually dictates whether a company can reward you is free cash flow. This is the tangible hard cash left in the bank account.
After paying suppliers, workers, and governments, right?
Exactly. And AngloGold reported free cash flow of $727 million for the quarter. That is a 36% growth rate over last year.
That $727 million is the ultimate truth teller. I mean, you can't fake cash in the bank.
Nope, you really can't.
That is the exact pool of liquidity that management now has at their disposal to pay down debt, fund future growth, or directly return to you in the form of dividends and buybacks.
And we cannot ignore the sheer force of the environment they are in. The average gold price received by AngloGold Ashanti this quarter was $4,446 per ounce.
Which is just wild to think about.
It is. Just to give you a sense of the whiplash here, a year ago they were receiving $3,287 an ounce. The commodity surged by over $1,000.
It completely rewrites the unit economics of every single mine in their portfolio. When the price jumps, that violently low-grade ore that was previously considered waste rock suddenly becomes highly profitable.
But see, this is exactly where my skepticism kicks in. I mean, think of it like a lottery ticket.
Okay, I'm listening.
The gold price went up roughly 35%, but their bottom line earnings went up 58%, hitting $1.01 billion in headline earnings. So I'm looking at this and thinking, did management actually do anything special here?
You're wondering if they just got lucky.
Yeah. If I hold a winning lottery ticket in a massive gold bull market, I don't get to call myself a financial genius just because the numbers look great. Are they operating a fundamentally tighter ship or just getting incredibly lucky?
Well, what's fascinating here is that the CEO, Alberto Calderon, actually had to address that exact friction point on the call. He knows the market is looking at that gold price and assuming the commodity is doing all the work.
So how did he defend it? Because if costs are rising too, shouldn't that eat into the margin?
It comes down to the relationship between fixed and variable costs. The mechanics of what you just described, the gold price rising 35% but earnings rising 58%, is the textbook definition of operational leverage.
Walk me through exactly how that leverage works in a mining context, for the retail investor.
Sure. So in mining, your fixed costs are astronomical. You have to build the processing plant, maintain the haul roads, power the local grid, and pay your core salaried staff, regardless of whether gold is at $2,000 or $4,400.
Right. Those costs don't change just because the gold price does.
Exactly. So once you cover those massive fixed costs, every incremental dollar in the gold price drops almost entirely straight to the bottom line. They took that 35% tailwind, covered their fixed base, and leveraged the rest into a 58% bottom line explosion.
Ah, okay, I see. So they didn't just passively ride the wave. They maintained enough discipline over their fixed cost structure that the revenue surge wasn't entirely consumed by internal bloat.
Precisely. In past mining cycles, like the boom around 2011, management teams were notorious for letting costs spiral out of control the moment gold prices rose.
Oh yeah, I remember that. Buying up everything in sight.
Right. They would hire aggressively, build lavish corporate offices, and completely lose their discipline. Calderon is demonstrating that AngloGold Ashanti is capturing the margin. They didn't just ride the wave, they captured the margin.
That distinction is crucial. You want your individual equity holdings to outperform the base commodity. But to really test that theory, we need to look at what it actually costs them to pull those ounces out of the ground. Let's look at the story behind the numbers.
Which is where things get a bit more complicated.
Definitely. Because they reported a 7% drop in gold production down to 744,000 ounces.
And that figure is the perfect place to start.
Right, which immediately feels contradictory to me. If the price of your product is at an all-time high, basic economic theory says you should be maximizing output. You should be scooping up every ounce you can.
It does require a very clear explanation. And management actually provided a two-part explanation on the call. The first part of that production dip stems from a deliberate strategic corporate decision: the sale of the Serra Grande asset in Brazil.
Now, Serra Grande was a relatively small, older asset in their portfolio, right?
Exactly. In mining, you categorize your assets by tiers. Tier 1 assets are the massive, long-life, low-cost operations. Serra Grande was a classic Tier 3 asset. It was small, it had higher costs, and it consumed a disproportionate amount of management's time.
So they essentially pruned the tree. They accepted a short-term hit to their total production volume to increase the overall quality of the remaining portfolio.
Yes. And from an investment standpoint, you cannot penalize management for losing those ounces. They traded them away consciously to optimize the business.
I agree with the logic on Serra Grande. It shows discipline. But the second reason for the production drop is not a strategic choice. It's a severe operational failure.
Yeah, that was the safety suspension at the Obuasi mine in Ghana.
Right, they had a tragic worker fatality in April.
It is a stark, sobering reminder of the physical reality of this industry. We can sit here and talk about EBITDA all day, but mining remains an inherently dangerous, heavy industrial undertaking.
Can you break down exactly what happened at Obuasi? Because a safety suspension doesn't just mean turning off the lights for a weekend.
No, it's a massive disruption. The incident occurred in the KMS shaft, specifically involving the ore passes. To understand this, you have to visualize underground mining mechanics.
Okay, paint a picture for us.
So you are drilling and blasting solid rock deep underground. Once you blast that rock, you don't immediately truck it to the surface. You use gravity. An ore pass is essentially a massive, steeply inclined tunnel bored through the rock inside the mine.
Like a giant subterranean chute.
Exactly. You dump the broken ore into the top of this pass, and it funnels down to a lower level where it is gathered and hoisted to the surface. Controlling the flow of thousands of tons of jagged, heavy rock falling down a vertical chute requires immense engineering.
Wow. And there was a failure in that system.
Yes, there was a catastrophic failure in the system that manages that flow, resulting in the fatality.
And rightfully, they immediately suspended operations. They halted everything for 2 weeks to investigate.
Which is the absolute bare minimum standard today. But the ripple effects extend far beyond a 2-week pause. Even after they resumed general mining, they had to completely sideline the KMS shaft ore passes.
So how are they getting the ore out now?
They are currently operating without them while they engineer and build an entirely new system from scratch. Management noted it won't be fully operational until the fourth quarter.
So they are essentially routing around the damaged infrastructure. That has to introduce massive inefficiencies and slow down the entire cycle.
Precisely. It bottlenecks the mine. You can have the highest grade ore in the world, and gold can be at $5,000 an ounce. But if your internal logistics chain breaks down, your production plummets.
Which brings us to the most painful data point of the entire quarter. Total cash costs, or TCC, skyrocketed to $1,480 per ounce. That is a massive 21% increase over the prior year.
Yeah, let's clearly define TCC for the listeners so we understand exactly what that number represents. It is the purest metric of day-to-day operational inflation. It's the hard physical cash spent directly at the mine site.
So this isn't corporate overhead in a fancy London office or the long-term capital used to build a new tailings dam.
No, this is the raw cost of survival at the rock face. Wages, massive quantities of diesel fuel, explosives, chemical reagents, and the direct royalties paid to host governments.
And when that metric jumps 21% in 12 months, it means the fundamental cost of doing business is accelerating aggressively.
It's a huge headwind.
And this is where my leaky bucket analogy really takes hold. Management loves to talk about their internal discipline, but looking at a 21% spike in day-to-day costs, I have to push back.
I don't blame you. It looks bad on paper.
Right. It looks like the $4,400 gold price is a massive fire hose filling up a bucket, but the bucket is riddled with holes. Cost inflation, safety suspensions, logistical bottlenecks.
The water level is rising because the hose is on full blast.
Exactly. But what happens if the gold price normalizes? What happens if it drops back to $3,000? With costs running at almost $1,500 an ounce, that bucket is going to drain incredibly fast.
It is the most important question an investor can ask right now. Does this company collapse under its own weight if the macro tailwind dies?
So how did management explain this away?
Well, the CFO, Gillian Doran, dedicated a significant portion of the call to addressing this exact fear. Her argument hinges on dissecting that 21% increase to isolate what management can actually control versus what is being inflicted upon them.
Okay. Break down the inflation for us. What is inflicting this pain?
The first and most violent culprit is global energy markets. Brent crude prices spiked 45% year over year during this period.
And we aren't talking about a fleet of pickup trucks here.
Not at all. We are talking about open pit haul trucks. These machines are the size of a 2-story house. They weigh over 1 million pounds when fully loaded with ore. A single one of these trucks can burn hundreds of gallons of diesel fuel in a single shift.
Wow. And they have fleets of these running constantly, right?
50 or more of these trucks running 24 hours a day, 365 days a year at a major operation. So when global diesel prices surge, the cost of simply moving rock explodes.
Okay, so fuel is a massive factor.
And it's not just the trucks. Look at AngloGold Sukari mine in Egypt. It's deep in the eastern desert, far away from any reliable national power grid. They rely heavily on their own on-site power generation using heady fuel oil.
Oh, man. So when Brent crude jumps 45%, the cost of keeping the lights on and the mills turning goes parabolic.
Exactly. That is an exogenous macroeconomic shock that local mine managers have absolutely zero control over.
Okay, I can see the fuel point. They can't control OPEC. What else is driving the TCC up to 1480?
The second major factor is currency fluctuations, specifically in Australia. AngloGold Ashanti is a U.S. dollar reporting company, meaning they sell their gold in U.S. dollars.
They don't operate in the U.S., right?
Right. They operate in places like Western Australia. So they receive U.S. dollars, but they have to pay their drillers, engineers, local suppliers, and local taxes in Australian dollars.
And over this quarter, the U.S. dollar weakened relative to the Australian dollar.
Yes. So suddenly, every US dollar they earn buys fewer Australian dollars to cover their local payroll. It operates as an invisible structural tax on their margins.
That's rough.
And to make matters worse in Australia, underlying local inflation essentially doubled, hitting roughly 4%. It's a highly competitive labor market there. To retain skilled underground miners, you have to increase wages.
So it's a double whammy. The local cost of labor is rising by 4%, and the cost to buy the currency to pay that labor is also rising.
It is incredibly difficult to manage. And then we arrive at the third and perhaps most ironic driver of that 21% cost increase.
Let me guess. Royalties.
You got it. The very thing making them rich is contractually obligated to drive up their costs. When you operate in a sovereign nation, you don't own the rock. The country owns the rock.
And you pay a royalty for the right to extract it.
Exactly. And critically, these royalties are almost universally structured as a percentage of top-line revenue, completely ignoring the miner's profitability.
So the government just takes their cut right off the top.
Right. It's like having a variable rate mortgage on a rental property, but the bank has a clause that says they get to raise your interest rate precisely on the day you manage to increase the rent.
That is a brutal mechanism.
Yeah.
So as the gold price skyrockets, the gross revenue explodes, and therefore the royalty checks they have to write skyrocket right alongside it.
It is an automatic cost inflator tied directly to their success. When you add up the 45% spike in fuel, the currency and inflation pressure in Australia, and the mathematically mandated higher royalties, it completely accounts for the jump to $14.80 an ounce.
Okay, I hear the defense. I see how the macro environment is beating them up on costs. But I still want to go back to my challenge. Are they actually operating efficiently?
This is where management introduces their flex cost metric. It's a fascinating way to grade a company's internal performance. They basically say, we accept that we cannot control global oil markets, forex rates, or sovereign royalty contracts.
So they strip those out to see the real operational performance.
Exactly. They isolate the purely controllable variables, the efficiency of the haul routes, the optimal use of explosives, the maintenance schedules. And when you strip away the fuel, the FX, and the royalties, their controllable costs actually fell in real terms year over year.
Wait, really? Their underlying operational execution actually became cheaper.
Yes. They attribute this to their full asset potential program, which is a mandate to hunt down and execute operational efficiencies. For example, they heavily optimized the metallurgical recovery at the Cuiabá processing plant in Brazil.
Extracting more gold from the exact same amount of rock.
Exactly. And finding ways to consume less reagent per ton processed. So the bucket isn't leaking because of internal negligence. The materials to build the bucket just got vastly more expensive.
That significantly changes the narrative for me. If their internal efficiency is actually improving beneath the macro inflation, then that operational leverage is real. And look at what they did with the cash that survived that gauntlet.
Oh, this is the best part.
Right. 12 months ago, they were carrying a net debt of $311 million. Today, they are sitting on a net cash position of $991 million.
That is a $1.3 billion structural swing in the health of their balance sheet in a single year. It's a complete financial transformation.
And they achieved it through aggressive debt retirement. They took $666 million of that free cash flow and decisively retired outstanding corporate notes maturing in 2028 and 2030.
Which fundamentally de-risks the entire enterprise. Think about the interest expense they just wiped off the income statement for the next 4 to 6 years.
By removing that debt, they lower their absolute break-even cost. So if gold drops back to the 3,000, they are in a vastly superior position to survive that downturn today than they were 12 months ago.
They have secured the financial fortress. They don't have looming debt maturities requiring refinancing at elevated global interest rates.
They took the windfall from the commodity boom and permanently fortified the foundation of the business. That is exactly what you want to see. But, the equity markets are ruthlessly forward-looking.
Right. The current stock price already reflects all this past performance.
That's exactly. So to determine if this stock is actionable, we have to look ahead at management's guidance for the rest of 2026 and beyond. Let's start with their full-year production targets.
Well, despite the 7% dip in Q2, the sale of Serra Grande, and the infrastructure rebuild at Obuasi, management firmly reaffirmed their full-year production guidance of 2.8 million to 3.17 million ounces.
That implies a massive ramp-up in the second half of the year. They have to deliver flawlessly in Q3 and Q4.
It is a profound signal of confidence. They are telling the market, We understand the setbacks, but we have the capacity to absorb them and still deliver our promised volume.
And they also maintained their cost guidance. They project full-year AISC, or all-in sustaining costs, to land between $1,780 and $1,990 per ounce.
Let's draw a sharp line between TCC and AISC for the listener. Total cash cost was just the day-to-day survival cost. All-in sustaining cost is a much more holistic measure of what it takes to run a mining business indefinitely.
Things like expanding the tailings storage facility or pushing the underground decline deeper to access new ore.
Exactly. Plus corporate administrative costs and exploration drilling to replace the ounces they mine each year. Maintaining that guidance between roughly 1,800 and 2,000 ounce is incredibly bullish against a $4,400 gold price.
It implies a sustainable margin of well over $2,000 an ounce. But here's where it gets really interesting. There's a detail buried in their forward guidance that could completely rewrite how the market values their cash flow in the second half of the year.
Oh, you're talking about the cash taxes.
Yes. Management guided that their cash tax payments are going to plummet from a seasonal peak of $542 million in Q2 down to roughly $230 to $250 million for Q3 and Q4.
This is the critical variable. Sovereign mining taxation is not a smooth, evenly distributed expense. It is highly seasonal and deeply complex. Q2 was an anomaly, a perfect storm of multiple tax bills coming due simultaneously across their global portfolio.
So they absorbed a $500 million cash outflow strictly for taxes in a single 90-day period. That's a massive anchor on free cash flow.
But, and this is the crucial part, even with that anchor dragging them down, they still managed to generate $727 million in positive free cash flow.
Now run the mental math for the second half of the year. They're removing roughly $300 million of cash outflow per quarter in Q3 and Q4.
Assuming the gold price stays flat, that $300 million in tax savings doesn't get absorbed by operational costs. It drops cleanly and directly to the bottom line.
It translates dollar for dollar into free cash flow.
You combine that tax relief with Obuasi returning to a normalized 150,000 ounce run rate for the second half of the year, and you have a recipe for an absolute free cash flow machine.
The market might be dramatically underpricing the cash they're about to generate over the next 6 months. But, an elite management team isn't just focused on the next 6 months. They have to allocate capital for the next decade.
Because mining is an inherently depleting business. Every ounce you pull out brings you closer to going out of business unless you find more.
Exactly. So let's look at their growth pipeline. How are they deploying this war chest to secure the 2030s?
They are executing a dual-pronged strategy. First, organic brownfield expansion at 5 core assets like Obuasi, Geita, and Sukari. These are established mines with existing infrastructure. They believe they can increase current production by 10 to 15% within 3 years.
Which is incredibly capital efficient compared to building a new greenfield mine from scratch.
Vastly superior return on invested capital. But the true crown jewel of their long-term growth is in North America. They are aggressively advancing their Nevada strategy.
Right. They are targeting a record of decision for the North Bullfrog project by the end of 2026. Explain what a record of decision actually means in the context of U.S. mining development.
Well, developing a major industrial project on federal land triggers the National Environmental Policy Act, or NEPA. It is one of the most rigorous environmental review processes on the planet, assessing water tables, sage-grouse habitat, air quality. It takes years and millions of dollars.
It's the ultimate bureaucratic gauntlet.
It is. A record of decision is the official document issued at the end of that process. It's the ultimate green light that allows a company to mobilize heavy equipment and pour concrete. Achieving that by late 2026 means North Bullfrog is on the precipice of actual construction.
And Nevada is universally recognized as a Tier 1 mining jurisdiction. It's the ultimate geopolitical hedge for a portfolio that is currently heavily concentrated in Africa and South America.
It balances the risk profile of the entire company, making the stock more palatable to conservative institutional investors.
Now, speaking of the future, there was a fascinating exchange during the Q&A about technology. Everyone wants to shoehorn AI into their earnings calls right now. But how does a heavy industrial miner actually use AI?
The chief technology officer, Marcelo Godoy, had a refreshingly pragmatic response. They are heavily invested in machine learning for predictive maintenance.
Like monitoring the sag mill at a processing plant, right?
Exactly. A massive rotating steel cylinder grinding thousands of tons of ore. If a critical bearing fails unexpectedly, the whole plant shuts down, costing hundreds of thousands of dollars an hour.
So they use AI to ingest sensor data vibration, temperature to predict when a part will fail.
Right. The algorithm detects microscopic anomalies weeks before a human would. They order the part in advance and schedule replacement during a planned maintenance window. That is real AI value in mining.
But Godoy was also very clear that they are keeping a strictly cautionary approach to generative AI and what he called agentic AI.
Yeah, agentic AI refers to systems that have the agency to execute actions in the physical world autonomously. In a heavy industrial setting, handing over the keys to an autonomous agent is terrifying.
An AI hallucination controlling the ventilation system in a deep underground mine could literally be deadly.
Exactly. It shows a management team focused on margins and safety, not just buzzwords.
Okay, we have systematically unpacked the quarter. So what does this all mean for the retail investor? What's the bottom line?
If we connect this to the bigger picture, the verdict on AngloGold Ashanti is unapologetically bullish.
Let's validate that bullish stance by looking at how they are treating shareholders. They declared $364 million in dividends just for Q2.
That brings their total declared dividends for the first half of 2026 to $949 million. They returned nearly $1 billion in cash directly to shareholders in 6 months.
And their dividend policy has a stated floor, plus an annual true-up mechanism to pay out a full 50% of their free cash flow. Because cash generation was so immense, they applied their discretion and executed the true-up early.
It's a phenomenal yield story. But dividends are only half of the capital return equation. Shareholders just approved a massive $2 billion open market share buyback program.
Though they are waiting on final authorization from the South African Reserve Bank due to legacy regulatory hurdles, right?
Yes, but assuming that goes through, a $2 billion buyback is a game changer. AngloGold Ashanti's Tier 1 assets are currently operating at a 71% cash margin at these gold prices.
A 71% cash margin. That is absurd profitability for a company pulling rock out of the ground.
And instead of using that margin to build an empire and overpay for acquisitions, they are aggressively shrinking the share count. By permanently retiring those shares, every single remaining share claims a larger percentage of that massive free cash flow moving forward.
So for anyone holding or considering the stock, this is a premium cash flow story. Management is heavily prioritizing shareholder yield. As long as gold prices hold, AU is structurally positioned to reward investors with both a generous dividend floor and buyback-driven upside.
It is the defining example of how to run a mining company during a commodity supercycle.
However, before we sign off, I want to leave you with one final, highly provocative thought. We've painted a very bullish picture, but there is a macroeconomic wildcard lurking just beneath the surface.
Yeah, the concept of resource nationalism.
Exactly. Deep in the Q&A, it was noted that the government of Guinea is actively attempting to mandate that gold produced at the Sigiri mine must be processed through a new, local state-mandated refinery.
Instead of allowing AngloGold to export the raw gold to global refineries of their choosing, it is a classic move in the resource nationalism playbook.
Now, management gave a highly diplomatic response, saying they expect to handle it as business as usual. But regardless of how smoothly they resolve it, it raises a vital question for you to ponder.
When gold is above $4,400, the sovereign nations that host the ore are watching these earnings calls too. They see that 71% cash margin.
Exactly. So as long as gold stays at these levels, how long until other host nations demand a larger forced slice of the pie? And what will that do to the margins of global miners?
It's the sudden renegotiation of contracts or the implementation of aggressive windfall taxes. It's a macroeconomic infection that doesn't show up in an EPS report until it's already degraded the long-term margin profile.
Keep one eye firmly on the geopolitical landscape as you watch those generous dividend checks roll in. The sovereign nations know exactly how much money is being made. Thank you so much for joining us for this deep dive into AngloGold Ashanti. Keep your portfolio sharp and your perspectives wide.